Okay, welcome to another wonderfully exciting video on project finance modeling and creating a project finance model from A to Z. And I wish I could figure out how to make this exciting by making it like a sporting event or something, but I don't know how. I'm going to make sure if this is louder. I doubt that's just the speaker. I'm going to begin. We're going to, in this case, I have already opened the file. That's really where we left off. Not exactly, but we're going to make this exercise as a file titled After Tax Cash Flow and Project IRR. You might think, just to introduce this, to get the pre-tax cash flow, we have our components already. I haven't computed it, but revenues minus operating expenses would give us the EBITDA. Less CapEx would give us the free cash flow, unless we got really fancy and put in some working capital assumptions, which perhaps we should do. So why don't we begin that, and let's just simply put in the working capital and put days receivables, and let's put days payables. And that's going to convert, and we can put days and days. And you know, for an electricity project, you might be metering your revenues every single hour, but you don't send your bill to the end of the month. So we have 15 days there, and maybe the utility doesn't send it back in another 35 days. So maybe you have 45 days. Maybe we have, on average, 20 days to pay our O&M suppliers and all that, okay, from the time we record this. So what we're going to need to do before we compute our free cash flow, let's just remember kind of what the key components are. So why don't we compute our working capital, and we can put accounts. Sorry about typing in the titles. As percent of revenue, and then we can put accounts payable as percent of expenses. Then once we do that, and we can put level of accounts receivable, which will go on the balance sheet. We'll put level of accounts payable, which would, which will also go on the balance sheet. We take the difference and we call that working capital. And then we get the change in working capital, which is just the difference between one period and the next. The only issue here really is the fact that we can't divide it by 365. We divide it by, if it's the number of days, we divide it by however many days we had in the month to get our percentage. So it says days of the month 31. That's the only slight little thing with working capital. And then let's just make sure that we work through our pre-tax cash flow, which is just our EBITDA first, revenues minus expenses, less the capital expenditures, Now you notice that these capital expenditures have absolutely nothing to do with any interest during construction, fees capitalized, DSRA, anything like that. They're pure, and that's what they're supposed to be. And then we put less the working capital changes. Now when we did that and compute our pre-tax cash flow, we've got everything except the we've got everything. Why don't we do this? We've got everything except the taxes, and so we'll put a monthly, and then we'll put an annual, and that's going to be exciting to get to see what a real. Now, after we get the pre-tax cash flow, the next big section of our model, we put EBITDA in here, I think is going to be our taxes, but taxes as if we had no interest. So we can put EBIT and taxes on EBIT. Now this is, we have to be very careful. If it's free project cash flow, we're going to start with our depreciation expense for tax purposes that has no depreciation expense on interest during construction, no amortization of fees, no nothing. It's pure, no financing. And to get that, I think we need our plant balance and our depreciation rate, and then we can get our depreciation expense. And then for the balance sheet, why don't we also put our why don't we also put a accumulated depreciation, and we'll put our net plant balance. And the reason I'm doing that is we want to make absolutely sure that that doesn't go to zero. Then we can compute our EBIT, and then we can compute our taxes on EBIT. Okay? Once we have the taxes on the EBIT, then we have pre-tax cash flow, less taxes, and we get our after-tax free meaning free, available to investors flow, and then we can get our project IRR, which is the objective of this exercise and an exciting thing to compute. Now, when we do, I think I also want to begin introducing the concept of a net operating loss carry forward in this circumstance. Now, the depreciation is a little bit tricky. So after we've finished all our operating assumptions and we put our working capital assumptions in, let's put some depreciation assumptions. How about we'll put a whole section here for and tax assumptions. Let's assume that our income tax rate is, I hope you don't hear the game downstairs, with a percentage sign. Let's say that's 25%. And let's put our tax life of, I don't want to make it this time in years. Let's say it's 10 years. Let's say we've got some fast depreciation for taxes, and let's say there's a declining balance factor, just this is times, let's say it's 1.5. That would mean that the depreciation, instead of being 10% in the first year, would be 15%. But it couldn't be 15% over 10 years. It has to decline and ultimately add up to 0. Now, to do that, there's a nice little function. You can put the year here. And for this, you need to start, oh no, it's 0, and then let's go up to enough, Alt-EIS, enter. Okay, and we could make it longer, but this is good enough. And then let's put our rate. And to do this, you use VDB, variable declining balance. You can put 1 in for the cost, 0 for the salvage. The life you can put in with the F4 button, and then you put the start period in period 0, and the end, the start period in the prior period, and the end period in year 0. Okay, whoops, sorry. Okay, let's just make that a percentage. I hope I have fixed that little. And Shift Control R, and then, oops. Okay, where are we? Oh, it opened another file and then took it. It worked till year 10. After year 10, it didn't like it, so maybe we put a little if statement. As long as this number up here is less than or equal to this number, 1, 2, 3, 4. By the way, you need to start with a 0. You don't need to put it as a 0, but the next one over needs to have a 0. So now we have it here, and we can check. Let's just make sure that it all adds up. Okay, that all worked. That's Shift Control 1. Okay, that's our variable declining balance. Now, I think this looks a little bit like our table over here, so we can use our lookup function. Excuse me, if you remember, we can even try our newfangled lookup function that will make sure the NA doesn't work, and we have to make sure that this really goes to 0 and not to false in the model. So let's begin our analysis. So accounts receivable, this is going to be USD thousands. In fact, just about everything in the rest of the model will be. It's almost not worth putting into this, but why not? Just for this one, okay. And then, come on. Oh, I guess these aren't. Okay, enough. Probably won't bother putting it in. And then let's put the days. Okay, and our days accounts receivable were 45. Now, I had one person who told me, well, what happens if you're doing a real accounting analysis and it's one day later and all that? You could get crazy about and do some sort of daily analysis. But I think, why don't we just take this one and divide that by the number of days. So we have a number that's bigger than 1, Shift Control R, and obviously I didn't press the F4 on 1, 2, 3 on the top. Okay. Now once we have that, well, our level of accounts receivable is going to be this. Oh, my dog's barking. That's good, because she's really old and not going to be here for so long, so which makes me very sad. She's sick. Okay, and then now let's do the same thing for the days accounts receivable, and that dog usually helps me make the videos too. She's not helping right now though. Okay, and then we take the same thing. We take this number, press the F4 button, divide it by the the number of days. Okay. Oh no. Shift Control 1, Shift Control R, and we multiply this one by the... Ah, crap! I'm making a video! Okay, we're back. No, that was not a problem. Okay, so let's take our accounts receivable minus our accounts payable, and then let's take this level minus the prior level, and we'll have our working capital balance modeled. And as you notice, what happens is we get a big balance of working capital. We get a big change in the very first year, and then the change is very small after this. We better finance this somehow. This is part of our financing needs. And now we can compute the EBITDA, which is just the revenues minus the expenses. This will be used a lot in the model. So, and then we can take the capital expenditures, and we can take the working capital changes, and I suppose we could have put a minus sign on this one and a minus sign on this one, and then we press Shift Control R, and then, oops, that would have been nicer if it, and then Alt equal. It didn't, the Shift Control R didn't leave it there. And let's, why did that not like that? Did it make a Shift Control 1? Okay. All right, and now our pre-tax IRR on a monthly basis, and here's what happens. No need, absolutely at all, to compute the, to use the XIRR and put, how about we put 0.001 or something. Oh, and then we get a small IRR, but don't despair, that's on a monthly basis, so our annual IRR is 1 plus the monthly IRR raised to the 12th power minus 1. We got a glorious 4%. That's almost like a wind farm in Germany, but that's after it's kind of operating. So here's what I'm going to do. I'm just going to cheat. I hope you don't get mad at me for this, but we'll make it 70 as our price. So maybe this is some kind of, I don't know, subsidized merchant. How about that? So now let's take our plant balance. I could have done an opening balance and add the capex and all that, but it's really not worth it. And what I should have done is put a minus sign here. So that's our plant balance. Now the depreciation rate depends on our age in years. Do you remember that? And I think we might be really lucky that we already have in our age in years. And then we can use, I'm going to use lookup. No, let's use lookup 1. We look up this one, and then we click on the year like this, and then click on the rate. Okay. Shift Control 5. Now don't remember, this is an annual rate, so we better divide it by 12 since there are always 12 months in the year. I'm gonna hope you don't get angry at this. Some people could say so. And there's our monthly depreciation, and it's changing. And it's going to 0. And we should really, remember, we're almost reserving this. If we take a sum of all of the depreciation rate, that's equal to 1, and we should kind of put an equal. Okay, and then our depreciation expense, I don't know why, put a line down there, is the plant balance times our depreciation amount, and And then our accumulated depreciation is the prior amount plus depreciation, and our net plant balance is the plant balance minus the accumulated depreciation. Okay, and I suppose, you should be very, very careful that the depreciation does not begin until the commercial operation date. The way we modeled it, it all works fine. Now, for the taxes, well, that's our EBITDA minus the, EBIT is minus the depreciation expense. Okay, and let's see what happens. We got a negative amount, so that's not going to work. We need to carry forward these negative balances. So now we've got a little more advanced issue, but not much. We put our opening balance, and then we add the NOL pushed forward, and then we take away the NOL used. I don't know if I should have said NOL pushed forward, but and then we put a closing. Now there are a number of other videos on this, so I'm going to do this one fairly quickly. Opening balance equals closing balance in prior year. We are going to push it forward when it's negative, when the EBITDA is negative, which means we make a maximum when we put a minus. Oops, and then put a 0. And then here's the most tricky one. We're going to use it only when number 1, this has to be positive. So, and also we can never use more than the opening balance. So we'll use either all of the EBITDA or the opening balance, whichever is less. And then our closing balance is our opening balance plus the amount we push forward minus the amount we take away. Some people say don't use this positive number convention, but we pushed it forward. Come on, it's finally coming. Finally. It took a long time to get rid of this. Okay, and then for the taxes on the EBIT, we can put a tax rate. Now the big modeling issue with the NOL is what happens if you run out. Now in a project finance model, that's not such a big issue. So if there's a 5-year cap or something, we have to put some kind of limit on this, but I'm not going to do that right now. And we're going to take the tax rate, and multiply that by the, oops, I didn't get an adjusted EBIT, excuse me. EBIT, which is our earnings before taxes that we started with, and then we add back anything we pushed forward, and we subtract how much we take out. And this adjusted EBITDA, I hope you like this I like this little thing. It stays at 0, and then it stays there, long, and finally gets up there. Okay, and then our taxes are just that number multiplied by the tax rate, F4, and we get it. So we can start with our pre-tax cash flow, which was here, and we can subtract out our taxes and get the, did I put a minus? Why didn't I put a minus this time? And then why don't we press alternate equal? You can press it like that. I hope you've been looking at how many different ways you can use the alternate equal. It's not just one way. And then we can do the same thing. What did we put? We put a percent and monthly and annual. Even though I have to redo it, I'll put it here, and wow, we're getting to the end. Okay, and we click on this one and put a 0.01 or something. Oh, 0.51. That means we get this much. And if you were theoretical, you would compare this to the WACC, which I would never do, but you could compare it to the after-tax debt IRR, whereas the pre-tax one you can compare to the pre-tax IRR. Now, why don't we do a couple things? So how about we put pre-tax IRR and after-tax IRR, and go and collect our numbers. This was the pre-tax, and let's get the after-tax. Okay, and let's just see how serious a delay really hurts us, for example. So if we delayed our project to 2021, oof, can we still get, uh-oh, it wasn't that bad. Let's just make sure we didn't do something really silly. Okay, well, I should really not waste your time on this. I hope you're turning off the video if you're not really interested, but let's look at our CapEx. Our CapEx stopped, and then we have this long period before we start to earn any revenues, so it does not look like we made any okay. And then let's do the other way. Let's say it's only 17, okay? And then, well, it goes up by a little, okay? And in this case, when we did the adjusted S-curve this time, oh no, it's still, yeah, we had to make a little adjustment in the last year to make sure we're spending the whole amount of the project, okay? So that's the delay, and if it was 2016, this will be a little more. I'll Control Z a couple times, one more time, and that's where we started with. And how about if I put a code number of, our code number had a P25, let's put a P50 and a P75. Oof. Okay. You better trust those consulting studies, which is a whole another section of the website that has not been fully developed. But I'm going to stop now and add some music to the file and all that. 15 minutes, not all that bad. Not that bad. Okay. No, 28 minutes. That is bad.